So it was pointed out to me that I never introduced myself. I was in such a rush to get started this morning. But my name is Shika Papo, and I am the chair of the Wharton Social Impact Club. And now we have our next panel, which is the Impact Investing panel. So we have, as our moderator, we have Jeff Cohen, who's head of business development at Sonnen Capital. We have John Jones, who's chief investment officer and social impact GM at GSV Labs. Paul Herman, CEO of HIP Investor. Debbie McCoy, who's managing director of BlackRock. And Fran Siegel, chief investment officer and managing director at Impact Assets.
Great, well, thank you so much, Shika. We really appreciate it. A wise man told me once that afternoon sessions, you can get a little bit tired, it's a little hot, and try to get folks moving. So if you guys don't mind, we're gonna kind of be a little bit interactive to get started. So by show of hands or jumping jacks or standing up, whatever you guys prefer, who here believes that impact investing implies that you have to take on a concessionary return? Well, these are our people, I guess. This is good to know.
About the opposite.
That's right.
Yeah.
Who thinks that it's only who thinks that it's only market rate?
I see a few hands, so I
And
guess
the rest of you
they're
have
not going
really
for the
good
standing up or the jumping jacks, but at least we'll get a start. So I guess another one, which may not draw too many hands, who feels like truly confident that they know the difference between impact, ESG, responsible, and sustainable investing? So this is the one where I expected no hands to be up, because it truly is a challenge of language and lingo and lexicon that we all face that I think we're going to try to endeavor to provide a little bit more clarity with the respective experiences that we have in our various organizations. So thank you all very much for being here. My name is Jeff Cohen. I lead business development at Sonnen Capital. Just to tie in a little bit more about what we're going to be focusing on here is we thought that we would try to link together a lot of the panels that you've heard already, as far as linking in some of Stephanie's comments as well as some of the measurement commentary that you got from the panel earlier, and apply that to what we all do, which is invest with an eye towards achieving market rate returns, and then in certain cases within certain areas of impact, impact first and somewhat sub-market rate returns. So with that, I'd like to kind of give all the panelists an opportunity to introduce themselves. Debbie, do you want to get started?
Yes, absolutely. I'm Debbie McCoy. I work at BlackRock as a managing director focused on impact investing. BlackRock last year launched BlackRock Impact, a platform focused on sustainable investing. That really covers a range of styles of investing. So I've had the real fortune of spending the last 10 or so months traveling to see clients all around the world, institutional, retail, some individual, high net worth, and across different continents. I've been in Europe, I've been quite deeply across the US and in Asia. So have been learning a lot about the ways that investors are thinking about impact, and look forward to talking more about that.
John?
Sure, thanks, Jeff. Also, thank you to Shika and the Wharton team. Great job. We'll continue to try to make it a good day. It's also an honor to be up here with the panelists who we've had a little bit of a chance to visit with before coming here, especially on this gorgeous day here in the city. My name is John Jones. I am the Chief Investment Officer and Head of Social Impact at GSV Labs. In my capacity there, I get to raise, manage, and invest an early stage fund, as well as setting the impact strategy both for our organization and our community. GSV Labs is a global incubator and accelerator with presence in Brazil, China, India, and with headquarters just south of here in Redwood City, California, where we have a 70,000 square foot facility that houses about 150 startups. Those startups have raised just north of $200 million over the last 12 months. And we strongly believe that in order to best support them, we need to give them an ecosystem that mirrors Silicon Valley. So in addition to the startups who we house, who are the heroes and lifeblood of what we do, we also have a strong mentor network, including folks like Bill Campbell, Guy Kawasaki, who works out of our office, which is a lot of fun. We have investors housed physically with us as well. And we're also especially proud of being able to house several corporate innovation centers at our space, including Intel and JetBlue, who just moved in yesterday, which we're excited about. So I'm looking forward to the discussion. And for those of you who I haven't had a chance to meet, please come up and say hello later over drinks, which I think may be happening soon.
Thanks, John. Fran?
I'm Fran Siegel, Chief Investment Officer and Managing Director at Impact Assets, which is a nonprofit financial services firm focused on increasing the flow of capital to impact investing through innovative product development and field building. On the product development side, we run a $275 million donor-advised fund that is invested for impact across asset classes, so from the public markets to the private markets to real assets. We're working even on an innovative impact cash solution. So that's terrific. We have 800 clients. The separately managed philanthropic accounts that we do manage range in size from 5,000 to about 60 million. I don't know if, for those of you who don't know what a donor advised fund is, it's a charitable tax planning vehicle. So we are that's why we're a 501c3. So Paul has a liquidity event because his firm gets bought out by, BlackRock by Debbie, and he needs to maybe shelter some of the assets, and rather than start a family foundation, he would start a donor advised fund at Impact Assets with his namesake, and then he could invest the corpus or the endowment consistently with his values, and then also make grants. So they're almost like small family foundations. We also recently brought to market two innovative impact securities, one focused on microfinance and the other focused on global sustainable agriculture, designed to democratize access to impact investing by lowering investment minimums. So maybe we can talk about that a little bit later.
Great. Paul?
Hi, I'm Paul. I'm retired. I sold my company to BlackRock.
By the way, this is not a true fact for anybody listening.
Coming soon, maybe. So I'm a Wharton 1989 alum, and so extremely excited and proud to be here. Glad that Wharton has a West Coast presence, and that this room is full of entrepreneurial, global-minded, and impact-focused professionals like you. I was born in Chicago, and so my DNA is a mix of my father, who's a CPA, and my mom, who's sort of a budding psychologist. So human nature plus quantitative is what we try to bring together at HIP. So HIP Investor, I started in 2006, so this is our 10th year. Being in business for 10 years, we've now split into two companies. We have an investment ratings company. We produce 17,000 investment ratings, about 5,000 companies globally, 11,000 muni bonds, more than 1,000 mutual funds. So you can think of that like a Morningstar for impact, which Morningstar is finally catching up 3 years later. And second company is an investment management company. So to show that the ratings work, we have a large cap, sustainable real estate, global dividends, and other strategies. So that's in front of 9,000 advisors. So our work is producing and licensing investment ratings for investors, advisors, fund managers, and 401k plans. So if you want a 401k plan that's more sustainable, that's something we can talk about today, something you can do. We're excited to announce that in addition to doing a first push-button portfolio for fossil-free portfolios and 401ks, we're advising the first college endowment to go 100% sustainable or 100% HIP. And so you'll hear more about that soon. They're going to do it in under a year. So maybe we can get your schools and your endowments, maybe even the Wharton or Penn endowment, to go sustainable.
Well, can you just make sure your mic's on?
Okay.
Or maybe if it's dead, you can use this.
Okay.
All right, and I'll use my outdoor voice.
All right. Well, thank you guys very much. It's a rare opportunity to be on a panel with three of Stephanie's heroes. John, you and I have a little bit of work to do here. Just a little bit about Sonnen Capital, and then we'll dive right into it. Stephanie alluded to the report, the evolution of an impact portfolio. What we do is we're an independent investment management firm focused entirely on providing turnkey solutions across asset classes for asset owners, individuals, families, foundations who are looking for not only market rate returns, but also positive social and environmental impact, which we in turn measure and then report back out to investors, which is something that we'll hit on a little bit later. So going back to my second question, where I had asked for hands if anybody was really comfortable with the distinctions between impact, ESG, responsible, and sustainable, we didn't get any hands, partially because maybe folks are a little bit sleepy or their brackets got busted, or because they just don't know. And I think that that's really a challenge that we all face. And one of the things that a lot of our organizations are trying to do is create some frameworks and a little bit more of a structure around how you can identify and communicate what it is you're looking for, so that we can ultimately, as solutions providers, be able to work with investors that are looking to align mission with their values. So I thought that we would start with sharing a little bit more about what we define impact to mean. And Debbie, I thought maybe you could start.
Of course. Because I've been traveling around globally, I've had the great pleasure and also the slight embarrassment of realizing that a definition that works in many places just doesn't work someplace. I'll give an example to lighten it up. Socially responsible investing. Well, that can mean a lot of things to a lot of people, but there are a few countries in the world where that means exclusion screening only, nothing else. Not the general responsible social investing, but just very specifically taking things out. So about 45 minutes into a client meeting, I finally said, could you please define what do you mean when you say socially responsible? And they said, well, excluding, only, exclusively. And I thought, oh, well, we call that exclusion screening. Many markets would call that exclusion screening. So nomenclature and this conundrum that you mentioned is real. I like to have an open tent point of view. Anybody who wants to call what they're looking for something different, that's great. We'll describe what we're doing, always in a very transparent way. BlackRock's a big firm, and we have 3 main buckets in which we think a lot of investors do think about excluding items from their portfolios as a way to express something they care about. And let me even step back just a little bit. Many investors that come to us seeking some kind of impact or sustainability solution are thinking about a non-financial objective or a future financial objective. Reasonable people can debate that, incorporating these into risk and return portfolio. So for a moment, as students of finance, we ought to just dwell on the uncommonness of investors saying, please give me something apart from risk and return. Well, exclusions are one way to do that. We manage just over $200 billion in sustainable assets at BlackRock. A great majority of that is in exclusion screens because it's been a well-used, refined tool for many. ESG is the second segment we tend to think of, environment, social, and governance. There are many ways to think of how ESG might play in a portfolio. One could think of ESG integration, taking into account across the range of a portfolio, how is ESG being considered by individual companies or projects or other issues being treated in the portfolio. Some, though, are looking for high conviction, best-in-class ESG, in which case you would be looking at a much more targeted portfolio construction. So there's a range. If someone says to you ESG investing, a great next question is, could you say a little bit more about what do you mean? Finally, impact. There are, I think, very traditional and great definitions around capital driving specific outcomes. And there are, I think, more nuanced definitions around targeting outcomes generally. And so we treat both of those because we work in the private illiquid space where the former is much more prevalent. I know what outcome my capital is driving, and I probably have a say in reporting. And the latter, I invest in liquid securities. I can't tell the managers of publicly traded companies what to do, and I can't tell them what they have to report to me beyond what they report to regulators, in which case I can observe some of their activities in society to incorporate outcomes into my considerations of impact.
Great. And so obviously that covers a really nice kind of array on the equity, fixed income, and as well as certain private markets. John, from your perspective, as an accelerator, what does impact mean to you, and how do you distinguish it amongst some other words that may be used that might kind of confuse the message?
Yeah, thanks, Jeff. Impact investing and social impact are very loaded terms and mean different things to different people. Mm-hmm. And John, our keynote speaker this morning, talked about how the space is getting a lot more crowded very quickly. Which just I think leads to a little even more confusion. For example, for us, impact investing means finding highly profitable, highly scalable companies who also have the capacity, hopefully the desire, but also the capacity to have an impact. And I think and we call that profit plus. I think every company comes into this world in its purest state wanting to make a difference, whether it's to change the world or because two founders want to make the best company to work for of all the startups in all the land and all the kingdoms, which is pretty typical. And then somebody gives them money. And after they get money, most of them spend a lot of their time chasing the golden ratio of LTV over CAC and trying to figure out how to optimize and pivot there. And for the ones who do that really successfully, they wake up one day and they go, oh crap, the reason we started the company and our mission and the continuum that we swore we were going to stay on, we're not there. And typically that manifests itself in the form of formation of a corporate social responsibility group, which is good. That's not impact investing, that's charity. It's different, it's good but different. And that's kind of a little bit like saying, hey, I'm going to live my life and I'm going to focus on money and I'm going to do something nice right before I die. I don't think that works for people. I personally don't believe that works for companies, and I don't think it's how they drive the most value to shareholders, to the market, and to their employees. And I'll give just a quick example. A friend of mine is a lead engineer at a big data satellite company. And I was having lunch with him, and I spent some time in Rwanda last year, which was great. And an article happened to catch my eye the night before. And what his company does is really cool things around looking at satellites and seeing how many cars are in the parking lot at Nordstrom's every day and every hour and every minute, and using that data to incredibly accurately forecast revenues and earnings. And they sell this information to organizations like hedge funds, or they'll literally look at the shadows on oil reservoirs and try to forecast global oil supply or estimate global oil supply. And this article that I read the night before was from National Geographic, and it talked about how these game wardens are going out into the bush and they're trying to count the number of elephants, and they're getting killed by poachers and all kinds of horrible things. And it occurred to me to ask him while we were having lunch, look, if you can count the number of cars in the parking lot, can't you count the number of elephants in the world? And he's an engineer, so for the engineers in the audience, I love you, but he gave me a very engineering answer. He said, John, that is a non-trivial engineering task. And I said, okay, but can you do it? And he goes, you know what, we probably could. And he should do it because it's in line with his product set and his capabilities and what they're able to do. And I personally believe that would drive the most long-term value for them, for their company, for their shareholders. And this company is oversubscribed. They can take investment from whoever they want. And so getting back to impact investing, for me, finding companies who are trying to change the world is great, but finding companies who have the capacity to change the world and seducing them into staying on the continuum where I believe they can add the most value to their shareholders and to their employees, that's what I call impact investing.
Great, thanks for that. I think the one thing that's very clear is for anyone that says that you can only achieve impact in certain asset classes, I think that all of us would comfortably disagree with that. And you can achieve it in all sorts of different asset classes. It just manifests itself in a different way. So just shifting gears really quickly and thinking about the supply of capital, as in what does money want? I guess within you guys' respective businesses, where are you seeing interest from investors, and how has that shaped your strategic initiatives? I guess, Fran, we'll start with you.
Sure. So in our field, or based on our client set, both in the donor advised fund and we're in working with wealth advisors, one of the big barriers to capital flows are high investment minimums. And someone mentioned it, I think Stephanie mentioned it earlier, that in order to get exposure to what we call deep impact, which is investing in private debt and equity funds that then in turn invest in the companies that you guys accelerate, or a microfinance institution, or agricultural grower cooperative in Latin America, you need to be an accredited investor or even a qualified investor, a qualified purchaser. So the minimums are really high, and the suitability is very high. So it's not uncommon to have a $500,000 or $1 million bite size. But what we also see is a desire for that impact. And so what we try to do at Impact Assets is assess some of the structural barriers to the capital flows and figure out innovative structuring, innovative products, securities that can ease those barriers. And so that's one of the things that we're trying to work on through the donor advised fund, because we carry Paul's assets on our balance sheet, we're able to due diligence a fund manager like Stephanie mentioned, Sirona, which is a small, medium enterprise fund of funds that target underlying funds are in emerging and frontier markets. So that's exposure that we can't really get with a small investment team. And not only that, the investment minimums are really high. And so what we do is my team and I diligence the funds, we put them on the platform, and then we're the LP, we're the limited partner to the GP. So we're writing one check, and we're able to, Paul and all of our other clients, for as little as $25,000, give exposure to Sirona, or exposure to another fund on our platform is Microvest Short Duration Fund that invests in microfinance institutions in emerging and frontier markets. So democratizing access to impact investing by lowering investment minimums is something we're really passionate about. And we see this demand, this pent-up demand for exposure to private debt and equity. And these high minimums are something that we're trying to solve for. We're also trying to solve for the lack of distribution. So we have wealth advisors that are very far flung. They might be working in small wealth advisor shops or boutiques, boutique RIAs, or as part of a big platform like Merrill Lynch. And there's a paucity of products that can kind of travel in those wealth advisor channels. And so with the securities that we developed, we tried to create something that looks, trades, behaves, settles, reports like a traditional financial capital markets product. So it has, it's DTC settled, there's a CUSIP number, it's sort of something that wealth advisors are used to seeing, but there's the integrity of impact on the inside. And so that's another way we're trying to solve for the desire, the demand, the pent-up demand for deep impact investing.
Great. Paul, I'd love to hear a little bit more about, I know you had mentioned 401ks and democratization, how that's kind of shaped what you guys are doing in your strategic initiatives.
Sure, happy to explain. So Mike's working okay now. So as Fran mentioned and as Stephanie introduced, one of the challenges is how to act in accordance with your values and beliefs. And in investing, there's sort of two groups of investors. There's individuals and there's institutions. And some of those individuals have advisors and fund managers. If you're in a 401k plan, you're an individual. You should have an advisor attached to the plan in some way, might be provided by the 401k provider. There's fund managers in the plan, could be as few as 15, 30, some cases 50, or you might even have an open window where you can invest in anything. And then you have a fiduciary group inside the institution. So this is a lot of moving parts. And so in impact investing, a lot of the first movers, individuals who've been committed to 100% impact. So Stephanie was the head of Tonic, which is a group of investors who want to invest 100% of their for-profit portfolio for a mix of outperformance, market performance, and maybe concessionary return. And then there's a much smaller group of institutions that'll do it because it's a group decision-making process. And so this is what we all need to understand about impact investing. We're trying to get a group of people to agree to do something where they have to unlearn what they think they know, like modern portfolio theory. Things like tracking error in foundations. It's more important to track an index that is badly designed than it is to actually outperform that index. So these are some of the sort of technical issues that take a willingness of fiduciaries to have an open mind and to say, oh, that Nobel Prize winning modern portfolio theory from 1950 from the University of Chicago should be, right? It's 2016. So from a 401k perspective, here's what's happening today. Students on campus, like the Penn and Wharton campus or your alma maters, are protesting to the trustees to divest fossil fuels. Now, fossil fuels is coal, oil, and gas driven businesses, primarily producers. And so there's something called the Carbon Underground 200. So it's a top 100 coal companies who are dramatically losing market value over the past 4 years. The coal index has dropped 80%, 80. And the oil and gas index has lagged the S&P 500 for the past 4 years. So what happens in the trustees, in a room with trustees, is they'll say, oh, we need to, oil and gas has always made money. Sure, until 4 years ago. So that has disconnected. Renewables are emerging, energy efficiency is coming about, We've actually, through the renewables, both in China and US, we've levelized the greenhouse gases for the past year. So students are petitioning the trustees to divest, and the trustees, I looked this up this week because a sophomore at Penn wrote a full article about how difficult it is to deal with trustees. There's more than 50 trustees at Penn. And so doing the hard work of seeing who's on the decision-making committee to do that. So in a 401k plan, here's what's happening. Millennials, so Jeff is here from Sustainable Brands. We've worked with them on their 401k plan. Millennials want to be divested of fossil fuels. You can argue whether it's a good idea or a bad idea, but it's what they want. And so in the 401k, earlier you saw Good Wealth present as one of the ventures. You might think that all socially responsible funds are divested of fossil fuels. They're not. Some of them are even have more fossil fuels in the index from socially responsible brands. And there's other providers, including BlackRock, that have fossil-free indexes and funds, which you can invest in. And so BlackRock isn't known as a socially responsible fund manager generally when you look at that list, but it is in the fund for some fund managers. So in 401ks, what's happening now is a group of millennials are saying this is what they want to be happy at work. And employers are saying, we want you to be happy at work. We want you to have the choice to do that. And it actually works out where, at least for the current modeling, there's stronger financial performance. Both returns, because they haven't invested in oil, gas, and coal, which have gone down 20, 40, 80%, but it's less risk. And so a innovative-based portfolio, and that's really how you can think about impact. Impact is about innovation, not extraction. Innovating based on people, not extracting people to have the lowest possible cost per unit. So we all might have heard a CEO say at one point, people are our most important asset. Have we heard that? All right, finally, some hands. All right, do we believe it? Are people the most important asset of an enterprise? Yes, okay, great. All right, so for all the finance experts, where are people on the financial statements? Are they an asset on the balance sheet? No. What is it? It's expenses. And what do we want to do to expenses? Cram them down. So until we have a managerial accounting system that shifts this, then we're going to be stuck in the same place of being extractive out of people or extractive out of natural resources. Oil and gas sit as an asset on oil and gas balance sheets. It's possible we might not be able to process those or process those at the same rate. So those may either be stranded assets or liabilities. So that's just some frameworks to think about as you bring this back to finance class and to your professions. Impact, I'll leave you three things. Impact is measurable. It directly links to financial risk and return. Don't only talk about returns, talk about risk and return. And you can do it. You can do it in your 401k. You can do it in your own foundation that you have in Impact Assets, a donor advised fund. You can do it in your own portfolio. And if your advisor won't listen to you, find an advisor who will. And so you can tell us more about Sonin and being an advisor like that.
Absolutely, happy to do that later. So thanks for sharing that. Just switching gears a little bit. Obviously, as you can imagine, that's interesting to see the supply side. As far as people who are seeking capital in the impact space, everyone up here on this panel is probably included as part of that. Some of the folks who have sponsored this event as well. But I'd be interested, John, just to hear your perspective as far as some of the folks that you're seeing that are searching for capital, any underlying trends that you're seeing beyond just investment products and getting down to the company level.
Sure, I'll keep my answer pretty short because I actually think it's a pretty short answer. Paul had talked about millennials, and a lot of the folks who are doing early stage startups by definition are millennials. And when I came out of school, I think some crazy metric like 90% of us just wanted to make as much money as we can. And that's just not the case anymore. People coming out of school today, 90% of them want to have the biggest impact that they can. And I met with an entrepreneur last week, and we had a great conversation, and she had just met with all the big folks, Kleiner Perkins and Sequoia, and highly qualified. And all they wanted to ask her was all her financial metrics and not how she started the business or why she started the business, and it terrified her. And I think that we're seeing a lot of demand for capital come from people who are impact friendly and partner friendly and see that there's larger value there because that's what the startups feel. And I also think that as corporations mature, the millennials are on the cusp of having the buying power, and that's going to change, force change in how corporations behave responsibly and with impact. And it's not just going to be, it's not greenwashing, it's not marketing, it's actually how you earn high returns. So I think it starts there.
Great. Thanks for mentioning greenwashing and whitewashing, good washing. There's a lot of different phrases that are utilized basically to talk about folks that are disingenuously representing themselves as being responsible or impact oriented as a means to kind of cleverly market themselves to this growing area where capital is flowing. And one of the things that we do at Sonnen is we aim to report out the impact that our portfolios create on a quarterly basis and then comprehensively on an annualized basis, slicing and dicing all the different subsegments, within various factors that drive global equity, global fixed income, and all the other asset classes that you'd look to invest in a diversified portfolio. And Debbie, I'd be curious to know how BlackRock thinks about impact, communicating impact, and the reporting of it within the products that you guys offer.
Of course. Well, I knew that BlackRock Impact had arrived when I was accused, really right to my face, of being a greenwasher. At a conference, I said, yes, we're doing something right now. That's a joke because actually we made a decision at our firm that there is really this wide range of ways that investors might like to access some form of sustainable investing. When we're using the word impact at BlackRock for our strategies, we really demand that they meet a few criteria. One, we need to have targeted outcomes that are available to the investors to see before we create the portfolio. We don't want anyone to think, there was a great example, we don't want anyone to think they're getting a fossil-free portfolio if they're not, for example, or vice versa. Two, we need to be transparent and measurable. So that transparency does start with having the defined impact outcome, but then we must be able to measure these issues that we're outlining at the outset of our work. Finally, we're demanding a dual focus on the impact outcome and on financial return. So let me give an example and let me just present a little bit of the landscape and why is this challenging. I sit today and spend a lot of my time with the quantitative active investing team at BlackRock. We manage about $80 billion around the world. We manage a majority of the hedge funds that happen at BlackRock, and we go through 2 terabytes of data a day. That's a lot of data. And the basic thinking we have around sustainability and why, it's not really intuitive to people. Why would the quant investing team at BlackRock have launched the flagship impact liquid equity product? It's because there is a data challenge inherent in this sector. Companies, as I mentioned, have no requirement to tell us anything about what they're doing except for what the SEC says, ultimately, and a few other regulators. So you might have heard, if you've heard of SASB, the Sustainability Accounting Standard Boards, shake your head, raise hands, yes? Okay, Michael Bloomberg tends to be pretty determined, which is awesome, so it's nice that he's leading this effort up. There are efforts like this going on all over the world and all of the markets where we operate. There are relatively grassroots efforts to ask companies to do more of what we've talked about here, a bit more of a full accounting societally of what's going on. But there's a gap. There's today where investors would like us to incorporate these non-financial objectives, and whatever point in the horizon when it might become a regulatory reality that there are audited impact and sustainability financials. So from a measurement point of view, we think we have to do a few things. First, we have to decide what data are we going to target. What are the outcomes that we think investors would like to see in a portfolio? So that will differ. Everybody has a different definition of what is impact. We spend a lot of time with our clients finding out and listening to them. What are the areas of impact that you care about? And then we've got to ask ourselves, well, there are a huge number of societal issues, environmental issues going on in the world. If we're going to report outcomes, what's measurable? Where do we have enough data? So there are some great issue areas that we think are extremely important. Investors, our clients care about them, so do we. And they simply don't fall in the realm of areas we can measure. So we have to say we'll work on that. Right now, for example, we're trying to do a lot of work on water scarcity. We're using some geospatial mapping to try to think about this. We're not there yet. We've got a great research team thinking about it. We can't report it in a portfolio, so it doesn't belong there. Other issues are more straightforward. And so the focus we have, in fact, if you look in our SEC filing for a mutual fund that we just launched, we've actually gone to the trouble, it was really fun with the lawyers actually, we've gone to the trouble to list the outcomes that we're focused on in the portfolio. We want at every point really in the spectrum for investors to say, I know what I just bought, I know what my expectations should be for impact outcomes that I ought to be able to track over time, and I'll get dual reporting. I'll understand what are my financial reports, and I'll understand what are my impact reports when I hold this portfolio.
Great, thank you, Debbie. Paul, I'd be curious to hear about how you guys incorporate kind of this type of measurement and reporting out to your client base as well.
Sure. I mean, clients want to solve problems. So we've heard about Maslow's hierarchy of needs. How do we solve problems for health, for wealth building, for earth and environment, for equality, for trust? So for example, one important metric that links to financial risk and return is the number of women on the board of directors. So Credit Suisse has done 2 different reports on this now. So Credit Suisse, tree-hugging global investment bank, right? Traditional investment bank has done analysis of more than 3,000 companies. And what they found was 800 companies, 800 of the largest companies in the world have 0 women on the board. 0. So that's a risk. It's a risk not only because you're not being inclusive, it's a risk because you're not thinking in ways that half of society is thinking. And so what they found was this, that the return on equity, the profit, was 12% for those companies with 0 women on the board. And companies with 1 or more women on the board was 16%. So 16% versus 12%, a 33% premium. Every year that they analyzed it with a less risky line. So one of the things that we report to our clients is, what's the proportion of companies with women on the board? Because if you analyze an enterprise, what are your customers and your customer segments? What's your pool of employees? Who are your investors? And how are they represented across each of those? Your board should be representative of your customers and your employees. And if it's not, that's a risk, because you're not thinking how your customers and employees might. You might be thinking how institutional investors that are tilted that way, but you're not thinking how your customers and employees. So that's one tangible way. A second one are greenhouse gas emissions. So if you don't understand the science of greenhouse gas emissions yet, it's one of the things you must do. So we're carbon-based beings. That carbon is everywhere. Carbon was also in the dinosaurs 65 million years ago. The reason why we can put gas in our car is those dinosaurs died, they compressed, and that's a mix of oil-based carbon and gas-based carbon. Now, if you drive a car here, or even if you ride share a car here, when the pollution comes out the back of your tailpipe, that carbon that comes out the back, carbon dioxide, but the C part of it lasts for 100 years. So the more cars and the more people and the more driving that we do is what's happening today of that accumulation of carbon. So what we do is we analyze 2 things. One, the carbon producers. What are the reserves that are burnable, and how do you avoid those companies with those intense reserves? But more importantly, how are companies using carbon? And these are things known as Scope 1 and Scope 2 emissions. That's what they use internally or with their energy. And Scope 3 is what customers use. So Tide came up with cold water Tide detergent when they did a full life cycle analysis of how energy and carbon was used. And what they found was you not only save the carbon associated with heating the water, you actually bring down 80% of the greenhouse gas footprint. That's how organic yogurt, which feeds on grass-fed cows instead of corn-fed cows, when cows eat corn, they fart. And when you fart methane. And methane is like 23 times carbon. Now, methane also leaks out of Southern California and not getting plugged up, which is invisible. So these are the science-based metrics that we look at. And then we look at what is thought of as traditional business metrics, but are not valued. So customer satisfaction. Customer satisfaction started with J.D. Power. If you listen to an earnings report, you will almost never hear the words customer satisfaction in an earnings report. You might have customer retention, you might have customer renewal, but you rarely hear about customer satisfaction. Employee engagement. Now, employee engagement is one of those things where, anybody want to guess what the average engagement level of employees is nationwide? 30%, close. It's 20%. Now, that might mean that only 1 in 5 employees are engaged, but think about it this way. If everybody works 5 days a week, I know we work harder, but if everybody works 5 days a week, you're only engaged 1 day a week. So if you could double engagement to be engaged 2 days a week instead of 1 day a week, you've doubled your productivity. So the inputs to a business, and I want to make sure this is one of the messages we convey. The inputs to a business are people. The only people who can invent products are people. There's some machine-based learning, but to invent products, you need people. To serve customers, you generally need people. The number of people might vary. You need natural resources. So measuring the water, energy, greenhouse gases, and seeing if it's a closed-loop system or a wasteful system is important. All of these things build into your net present value and return on investment model. So we report those to investors and advisors. We do fund impact reports for fund managers, and we do this in 401ks. And these are 401k meetings that actually get attended because people want to know what's in their portfolio. So that's a mix of things that we look at.
Great, thanks, Paul. Fran, one area that we've seen, and obviously a few folks presented on earlier, was the really expansive growth that we've seen in impact investing. Obviously, there's been a lot of really good tailwinds with COP21, with the DOL's recent ruling on enabling fiduciaries to look at the space a little bit more with open eyes as opposed to just get it away from me, I'm not interested. From your viewpoint, what do you think, in no politics please if you don't mind, is the next big catalytic event that's going to hockey stick the space up even more dramatic fashion?
Are you sure no politics?
Well, I mean, it's
No,
up
I'm
to
kidding,
the folks here.
No, I'm kidding. That said, I mean, I do think that impact investing is something we can shop across the aisle. I always say that to my liberal progressive folks, I say that all the government aid in the world and all the grant capital in the world is insufficient to move the dial on the issues we care about. Won't you join me? And to more conservative audiences, I say we're trying to create private sector solutions to public sector problems. What could be more conservative than that? Won't you join me? So just fodder for Thanksgiving family meals if you have a family across the political spectrum. But in terms of the growth, Stephanie touched on this and others have touched on it. There's a $30 to $40 trillion wealth transfer over the next 30 to 40 years. The money will go first to women, because the women tend to outlive men, sorry gentlemen, and then to millennials. And we know that these two cohorts, 3/4 of each of these cohorts is interested in investing consistently with values. And so we see this as a huge change in the wealth in the wealth community. When the patriarch passes, the incumbent wealth advisor has a less than 50% chance of retaining the family wealth. When the matriarch passes, so both parents pass, the incumbent wealth advisor has a less than 5% chance of retaining the wealth. So when I speak to wealth advisor groups, and this is like put down the iPhone moment, is that there's just like a huge asset attrition that will happen over time. And for platforms, for companies, for individual wealth advisors, you may be retiring and playing golf by then, but for the platforms, this is hugely, hugely important. And because of those wealth transfers and because clients are asking for it, we start seeing these big players taking notice. We had Goldman Sachs purchase Imprint Capital, which is an impact investing pure play wealth advisor, which is a stunning kind of competitive preemptive strike because Imprint was being used by Morgan Stanley and others. We see you talked about Department of Labor and the ERISA regulated pension funds can now take impact factors into account when making asset allocation decisions, and so too around IRS rulings allowing foundation fiduciaries to take impact factors into account without jeopardizing the charitable tax status of the entity. So these came as a pair, plus we mentioned the Title III SEC ruling around equity crowdfunding from non-accredited investors. These three things happened in the last quarter of last year, and I think that from a supply of capital side, this will be incredibly transformative. And then, of course, we have BlackRock and Larry Fink issued a missive around the short-termism of Wall Street and a call to the public company managers that his firm works with to take ESG factors into account. And Warren Buffett actually, and thanks to Paul, some excerpts on that around to his investors. So I think on the supply side, we're seeing a huge change afoot. now and in the future.
Great. So I know we want to leave some time for questions, but I just wanted to get a quick, 20 to 30 second thoughts from the rest of the panelists on hiring trends that we might be seeing an impact for the students that may be in the audience, and thinking about where is there going to be opportunity and growth professionally in the space. I guess just one or two thoughts really quickly. Debbie, if you want to start.
Sure. Look, there is going to be a lot of growth in the sector, and my counsel, I do take a lot of calls from folks thinking about employment, is to think about what do investors need, what problem are they sitting with, and what about portfolio construction will you want to focus on. This will highly differentiate how you think about the types of roles that you might have an impact, and then your personal experience, what will you want that to be. I always try to invite individuals to think about scale, large versus particular, as a really important dimension of thinking about impact. I've been lucky to do both, and it's an important differentiating factor.
John?
I think this is the part where I'm supposed to say do what you love and all the other crap people tell you, which is the most inspirational, useless advice I've ever been given. Maybe I can make it a little more productive. If you are interested in impact and you want to do what we're doing, then figure out where your competitive advantage is. I have a non-traditional background as it relates to the rest of the panel, but I had the privilege of sitting in on the Adam Grant, Sheryl Sandberg talk 2 weeks ago now, and he talked about bringing your diverse background to play. So I think that if you find your competitive advantage, that's going to be highly correlated, hopefully, with what you enjoy doing, and follow that. And the good news about this industry is I know I speak for all the panelists when I say that by definition, we're interested in improving the world and having an impact. And to the extent that you can find a gap here or you can outperform one of us, every one of us would be willing to help you do that.
Yeah. Paul?
Sure. Well, I like to think of this in terms of skills, but also values. So the three criteria that we look at, which I think will carry you wherever you want to go, are 1, analytical rigor. So be analytically rigorous about something. Could be science, could be finance, could be people, but know how to be analytically rigorous, especially in an age of big data. 2 is know how to be collaboratively entrepreneurial. So know how to be entrepreneurial and taking something forward of your own initiative, but you don't have the biggest brain. The group of us has the biggest brain. So demonstrate what you can do there and write it down. So start using LinkedIn to publish what you think and create your own track record. And there's enough free media out there that are hungry for content, whether it's video, audio, whatever. Create and publish content, because what we get sometimes, and probably Debbie's experienced this, I'm passionate about impact investing. I'm sure you are. What is your expertise? What is your science, finance, or people expertise? And then the third one is, and this came from a client, so I'm just repeating what a client said. We like HIP because they're the nice people network. And so the great thing about impact investing today, and I think it will stay this way, is nice people who want to solve problems in a disciplined entrepreneurial way. So part of my background is McKinsey, but it's also Ashoka. And so the intersection of business, social, and government institutions is going to be what solves our problems. So as part of the Nice People Network, you create currency value for yourself when you pay it forward. Figure out who needs to get connected, figure out who to do favors for. Eventually you can come back and call in those favors. When I published the HIP book 6 years ago, I called in a lot of favors to help write it, edit it, publish it, and the like. So be the center of giving, and that people will naturally want to compensate for that.
Fran?
Mm-hmm. I agree with the analytical rigor. I run the investment team at Impact Assets, and I always say that I can homeschool on impact, but I can't homeschool on finance. Just too small of a shop. So I in the investment side, need to see that financial rigor, or the investment rigor, the rigor that comes with being an MBA student and graduating from a program which really teaches you about a line of inquiry. But also, I would say I've been reading a couple of articles lately about social heropreneurship. And it's about the fact that as students and as practitioners, we really kind of fetishize young folks. We believe that we can change the world on our own, and so we boldly go on a summer break or a spring break, and we believe that we have the tools and the answers for folks at the bottom of the pyramid, and that in some ways replicates what has been wrong with global aid. And so I believe that joining with other folks, not reinventing the wheel. Debbie talked about getting to scale. So I know that your stock and trade is, new companies, and in fact, in emerging markets and here, companies less than 5 years old create all net new jobs. So I'm not saying never start a new company, but think about partnering. I think that there's like a huge opportunity in M&A in our space. That would be really fun to raise, a couple $100 million, $500 million, and do a run at M&A, because I think that there are a lot of folks that believe there's a kind of ego that is required to start your own venture, and I think that doesn't necessarily always serve the impact cause.
Sure. Just one thought before we turn it over to questions. I made the jump into impact a year ago myself, so it is absolutely doable. You just have to really work at it, connect with the right people, just be really, really diligent about who you talk to, what you do, what you study, and really just communicate, as John mentioned, what your value proposition is to that organization, and it's absolutely something that can be done. So, turn it over to questions.
Thanks, Jeff, and thank you, panelists. So the first question is, how does a startup get past the stigma that a social impact-focused organization is a bad investment or more traditionally considered charity?
Is there an example with this, or?
There is no example.
Yeah. So I think the key in this is, what is the problem you're solving? And so despite the name of Charity Dress having charity in the name, it was really clear what the problem they were solving was, and what the engagement of the customer, and what the value that they were creating. So if you frame the problem in something that is visceral, people can't eat. Water cannot go into a supply chain to make Coca-Cola. The environmental efficiency of this building could save $500,000 a month. If you can frame it in what the return on investment is, the impact will follow. And one of the key things I tell everybody, if you're trying to pitch a sustainability initiative inside a large company, think like the CFO. Lead with the ROI and the payback, and say, would you be interested in a 4-month payback project? Yeah. How many of those do you have? Great. What is it? Like, lead with what the audience can hear, and then backfill with the rest.
May I just offer a counterpoint?
Sure.
So we invest at Impact Assets across the return spectrum. So we invest in market rate and premium rate individual companies and funds, but we also invest in concessionary entities and concessionary investment themes. There are some investment themes and some companies that have a change thesis that you're not going to get market rate, and that's okay. It just means that you need to reach out to different types of investors. And so I believe that there's a place for concessionary capital. I believe there's a place for philanthropic capital that is willing to make the trade-off, because in a foundation environment, all of your grant making is 100% loss. You're not getting that money back. And so if you're creating something that's highly impactful, where you're getting your money back and maybe a couple percentage points, especially in a low interest rate environment, doesn't look so bad. So I'm just making a shout out. I believe in market rate. I think we lead with market rate and we seek to mainstream this field, but it's more complicated than that. And certain interventions require more progressive notions of what constitutes blended return.
Thank you. John, is it better for the investor if the idea starts with social impact with a plan to revenue, or vice versa? And then the follow-up to this question is, how does an investor value the societal benefit versus profit?
It's a good question. I think it's related to the one that was just asked. I think every entrepreneur who starts their own company is by definition a little crazy, and starts with some significant deep passion somewhere that you can't make up, and you can't convey it in a way that's not genuine or authentic. So whatever that passion is, if it's a viable, scalable, big business, you should talk about it like that. If it's concessionary or something else, then you should talk about it like that. I like businesses that are highly profitable, where as time goes along, you can also talk about where your passion came from and why you're passionate about it. But most of the startups who I see are authentic and genuine around the passion and the purpose as to why they started their business.
Are you the voice of God, or are you getting questions from other folks?
I'm getting questions here.
Maybe both.
I'm just the guy who reads. So, let's see. Older companies are using another buzz phrase, triple bottom line. Do you see this as something different from social impact, or is it the same? And how do you differentiate this, if at all?
I might take this one quickly. I include triple bottom line in the panoply of terms to describe what matters. So in my big tent theory, great.
Agree.
I think it's
you.
audience specific. Know your audience and know what your audience is prepared to want. I think it's a total audience focus.
Right. Paul, I'll stay with you then. You mentioned how oil and gas has underperformed over the last few years, which has caused many people to justify divestment. I worry that over the next 5 or 10 years, sustainable benchmarks might underperform as energy prices rebound. How can negative screening deal with this?
So good question. And I actually heard somebody who's a sustainability fund manager say the other day they expect the top performers to be some oil and gas companies this year. Maybe. Nobody can predict it. Nobody thought oil would go back from 80 down to 40 and then 30. So there's two aspects to designing a portfolio. One is negative screening. You can choose to go fossil free. Another is to tilt, to do an overweight, underweight. So an input into many physical-based businesses is oil, gas. Count the number of things in your life that don't have oil, gas, carbon, or plastic in them. It's very difficult. So it's actually really difficult, maybe BlackRock's working on this for the next version of their index, to have a pure carbon-free index of how you live, what you eat, how you get around, and the like. So go ahead.
I was going to just add, in being students of finance and thinking about exclusions, you just, I think, need two things in mind. I'll hit oil and gas. One, what is the tracking error that you'll pick up versus a benchmark? Now, by the way, not everyone cares about benchmark. Some people don't. Some investors do. Know your client and what that means. I have some clients that have lists of 400 companies they've decided they can't invest in. And I say, okay, are you sure you want that portfolio? So I think having a really sophisticated conversation about who are you obligated to, if you have pensioners who need to get returns over time and you're going to get them lower returns with exclusions, you ought to be having a pretty sophisticated conversation for fiduciary and other legal reasons that are very important. So exclusions are delicate. As for oil and gas, also think about things like risk reports and future reports. CIA puts out, World Economic Forum puts out great future-looking research. It turns out 70% of the energy in the world right now comes from fossil fuels. And it turns out in about 30 or 40 years, still about 50 to 60% will. So keep in mind, a lot of people say, I know, all the money that's being invested will divert to renewable energy sources. It turns out the investors for renewable energy and early stage are different from the ones who are in oil and gas. So you want to be very clean with your logic, the analytical order you're going to have with clients to say, okay, if you divest from here, if you're a venture investor, you can reinvest over here. But if you're not, if you're in kind of pension fund land, you might not be able to do that. So you want to just be clear thinking as it relates to exclusions. What are you doing? How does it impact the portfolio? How would you make up for any difference if you're responsible to deliver returns?
And what future are you investing in? If you're investing for 50 years, do you believe that's part of our future? And do you believe that oil and gas will reinvent environmental science?
Thank you, Paul, Fran, Debbie, and John. And thank you, Jeff, for moderating. This is the end of this session, and Chika will transition to the next one. Thank you.